Hi, everyone. This is Rob Roy of LA Wave Options, and welcome to TradeFinder Live. If this is your first TradeFinder, welcome. Appreciate you being here. I'll give you a quick rundown of how things work. But before we get started, we have to go through this disclosure/disclaimer. If you've seen any of our video products, you've seen this before. It is important. Please take a screenshot of it, read it in detail at your leisure if this is the first time that you've seen it. Couple things that the powers that be want us to make you aware of. Number one, we are not registered to give individual investment advice in the United States. And number two, any pricing that we're talking about is assumed to be in US dollars unless noted otherwise. And that's an important detail because we have a lot of international viewers and we have a lot of international subscribers as well. So again, take a screenshot of it, read it in detail at another time if that's the first time that you've seen that. Here's how TradeFinder works. We'll do a brief market update, talk about what's been going on with the market. Pretty interesting day today. I think everybody would agree. Probably curious as to what happened with yesterday's market and then today. So we'll go through and update that. Then we'll do a review of any alerts that we have closed for our Elliott Wave Option alert subscribers. So it gives you an idea of what our website looks like and what our alert subscribers enjoy on the details there. So we'll walk you through one of those. Then we'll go back and do a review of our past case study considerations that we identify during TradeFinders, and we're going to cross a few more off the list. So we're going to be pretty barren after this. So things have really moved in the last couple of weeks. So hopefully you've been following along with those. Then we'll take a look and see if we can find a case study consideration for tonight. And with whatever time is left at the end, we'll open it up to general Q&A. We do have support staff on, so if you have any administrative questions, you can ask, but I'll take the questions regarding symbols, and we'll do that at the very end. That's what it usually amounts to. You guys give us your favorite symbol, and then we take a look at what our technical indicators say about your stocks. A lot of earnings after hours. I imagine you'll have some questions along those lines. But with that, let's go ahead and take a look at the market. So here's where we are, and you can see that we kind of came down towards filling that gap. So we gapped up on the 23rd and back down, didn't quite make it. So the high there was 435.72, the low was 435.99. So we missed it by what, 17 cents there. So we got awfully close to filling the gap. Didn't quite do it all the way, but seemed to be enough for people to step in. But importantly, if you've watched anything that I've produced, you know how I feel about the 10-day moving average. So here we came down and tapped the 10-day moving average on the low and turned around and moved back up. So it came awfully close to completely filling the gap, touched the 10-day moving average, and the market rallied from that point moving forward. Then we had Apple and Google and Microsoft all after hours, the big tech guys, and everybody blew away earnings. Microsoft did, they were down after hours. Apple did, they were down after hours. Google just smashed it. They blew away their earnings by 40%. They were up big after hours. We'll see if that holds into the open tomorrow. But the other tech companies, even though they did really well, sold off. So it gets to the point of, are we getting to the point where good news becomes bad news? And so that's something to watch with the markets. And as you know, we've been talking for a while of storm clouds that have been building, et cetera. And I think it's important to go ahead and show you the weekly chart again, because this just cannot continue. The market's been going up. And as I've mentioned in the past few recordings, we have been making you aware of the storm clouds because it's prudent to do that. It's important to keep those things in the back of your mind. Trade what the market's giving you, which is an uptrend. So you follow along with that, but also maybe you pare back on your risk tolerance a little bit and stay a little bit more cautious, knowing that there are some things that are concerning that are going on out there, especially with that Delta variant. We talked about that, and it seemed like the market shook it off for a while, but now we're getting all these mask mandates coming back again. And I think that's a little unsettling to the market. But here's what's unsettling to me. You can see that we have just a beautiful wave 3 on the weekly chart on the S&P, but look at the ADX. as the market is going higher, the ADX just continues to go lower. We showed this a couple of weeks ago in our SPY update on YouTube, and it's just gotten worse. So that's divergence. As the market goes up, the ADX is telling you the strength of the move is getting weaker. It can't continue like that. At some point, we're going to get a correction. And who knows when it's going to come. If we go back and look at the market itself, you know that the next level, based on the Elliott wave long count and on the weekly chart, is 460. Those are on the SPY videos on YouTube as well. If you haven't watched those, go back and watch them, because we go into a bit more detail on the markets. And if you are new with us, I encourage you to watch those, because we went through a series of 4 different zigzag patterns where we've hit the C wave extension. So now we're looking at what's next. So the Elliott wave long count and the weekly are both giving us 460. Can we make it there? At this point in time, we have a chance with touching that 10-day moving average and rallying off of that. But boy, wouldn't that be a nice pivot point right there if the market did sell tomorrow. So I think a lot of it is going to have to do with how the market treats those earnings tomorrow. If Apple and Microsoft, if Google's the only one that's up and all the other ones are down, it's going to be hard for the market to have a positive day. Right now, the futures are up 6. They just had a little bit of a spike there. Is what caused me to glance over. Pretty much after the market closed, the futures have been crawling back to the upside. So maybe we do break that high there and head up to 460, but this has to be concerning, and it will not continue. It just won't. At some point in time, they have to come back together and we get a corrective move. But until then, the market wants to go higher. So let's take a look at a couple other things. One thing I know that you're probably interested in, because you are each and every week, is Bitcoin. So let's take a look at Bitcoin and look at that breakout attempt. We've been talking about this descending triangle for how long? And it was in the TradeFinder that we talked about this downward zigzag pattern here that the market went right down to the 161.8% extension. And then we had this really nice descending triangle. The market gave a little bit of a head fake here on the 20th with a close below that 30,000 level. First time it closed below 30,000 in a long time. And then the very next day, we move back to the upside. Our subscribers are well aware that you need a second day, a follow through, a confirmation day, because those head fakes happen all the time to suck people in. And then quite often you get a reversal. And we did get a reversal the next day, then a couple of little bars, and then you can see, boom, this big day, which was yesterday's close, pull back a little bit today. So it didn't quite move back out above that 42,000. So it means we didn't get a follow through day to the upside either. But that was a pretty big move, and it was a pretty decent breakout from a descending triangle. Remember, just because it's a descending triangle does not mean it has to be a downside breakout. A lot of people say that, and that's just not true. Statistics don't bear that out. I've done an awful lot of work on triangles over the years, and I can tell you that it's a common thing. People say it, descending triangles break up, descending triangles break down. No, all triangles can break either direction. It's just a triangle to me. Doesn't matter whether it was a set of lower highs or higher lows. I don't know, it doesn't matter which way, it's still going to break out. But without the confirmation day, we can't say that that is a confirmed breakout either. It's clearly a breakout. There's no doubt about that, but it didn't get confirmed. So can Bitcoin turn and break higher? We also have the Federal Reserve in the middle of a two-day meeting. So today and tomorrow. So we get the results of the meeting tomorrow. I don't think anybody's expecting anything different from the Federal Reserve. Maybe the market's pausing in front of that just to see if there's any surprises, if they give any sort of hint on when they may start to raise rates or reduce the balance sheet. Maybe that's a little bit of what's going on the past couple of trading days, but I just don't think there's going to be anything significant. I don't think they're going to want to, this is just my opinion, so I take it for what it's worth, with the uncertainty still of that Delta variant, whether or not they're actually going to try to prepare the market for an eventual rate hike right now. doesn't seem like the best time. They're going to want to do that. They don't want to just spring it on the market. So they'll be giving signals ahead of time. I just don't think they're going to give one tomorrow. Maybe they do, but it seems like a kind of a shaky time to do that. And it could definitely rattle the markets if they did. So tomorrow could be a wild day. Maybe we open to the upside, but can we hold it? And it depends on what the Federal Reserve says. So I don't expect any change, but we'll see. Market may be looking for it. Let's take a look at the Qs, right? Because they've been the leader, right? They've been the ones that have been bringing the market to the upside. And you can say, yeah, that doesn't look too promising with that move lower. But let's look at the moving average here. And we actually traded below the 10-day moving average, but importantly closed back above it. So I think we've mentioned a couple of days ago, it might have been in a insiders meeting, that there's a little bit of a chink in the armor here. By the way, the insiders meeting we do every Thursday night, which is for our alert subscribers only. And that's where we go through all of our open alerts. And again, you'll see what an alert looks like here in a few minutes. But traded below it, closed back above it. Is that enough? You look at the DMI and we're starting to get that same type of a look that we have on the weekly chart of the SPY, where we're moving up here and the ADX is working its way back down. Of course, today was a down day, so you'd expect that little tick down. But even notice on this little move to the upside that we had here, that looked pretty good out of the Qs. The ADX actually still continued down even before that move today. So there was no real strength to that move. So the market's moving higher. So you trade that, but realizing that as it goes higher, I use a bunch of analogies because I just think it makes sense. But you get into thinner and thinner air, and things could fall much quicker. The further we go, the further into the thin air we go. In other words, the more divergence, the further the market goes to the upside without any strength behind it, the stronger the correction may be. So we'll see if the Fed gives enough juice to keep the market going up to 460. I know that's the next level, but it wouldn't surprise me with all the zigzag patterns that have been achieved. If we were to reverse now, I think that would be totally fine. I think the market needs it, actually, because there's just some things that are too overvalued. And when you see earnings reports like we had after hours and the stocks trade lower, it tells you that the expectations are probably way out of whack. And then let's look at the small caps, because the IWM has certainly been churning sideways for quite a while, and it still is. Now it's tightening a little bit. So this is, I find, a really interesting pattern. As you all know, if you've listened to any of the recordings, I'm not a big fan of trading sideways stuff. But here we have this big trading range, and now we're kind of ending that, and it almost looks like a big arrow. I've drawn these before, where we're having a bit of a triangle here right at the end of, and so if you slide these back, you can see where it just looks like a big old arrow, where you had the trading range that has moved into a symmetrical triangle. So I think the small caps are getting ready to make a move now. And if they broke to the upside, that would certainly be some support for the market to move higher, because the market's really been doing this without the small caps being involved. They've just been churning back and forth in this trading range. So that triangle, I think, is quite interesting in the IWM. So for our international viewers, we'll go ahead and look at the XJO as well. That's Australia, and they've been in this kind of a, I've been calling it like a kissing triangle, a consolidating triangle followed by an expanding triangle, and you can see that they're just kind of, they're kissing, and the points are at the same spot. So are we breaking out, or was that like testing the upper line and then we've peeled back a little bit? You can kind of make a case for both, but regardless, if you're trying to look at yesterday as a breakout day, then today certainly is no follow through. So it doesn't really matter whether you view that as just testing the upper trend line or a breakout attempt that's failed. There's no follow through to it. So I don't think we're getting much of a signal there on where the Aussie market wants to go. Either still at an 85, or excuse me, an 88% extension in the wave 5, which means if that starts to fail and correct, yikes, that's a pretty long move all the way back down to that previous 4. So remember, on the rules of Elliott wave, in the wave 5, if the wave 5 doesn't extend 100%, then the corrective move is back to the previous 4. If the wave 5 extends beyond 100%, then the corrective move is 61.8% of that wave 5. So you'd like to see that certainly move above that, so that, or above 100%, so that when the correction comes, it's not as severe, just moving down to the 61.8% level. And it's amazing how accurate that works. So that's the markets. And then we'll go ahead and take a look at a case study that we recently closed. This is what our alerts look like on a website. So there's our website, EWO. Each trade has a screen just like this. There's a whole list of them under the trades tab. And so you get the stock symbol. It has a trade ID, each individual alert. And then there's the entry, the exit, what's the strategy, which portfolio is it in. So I want to show you this one because this one was in our high value volatility strategy. The volatility strategy is primarily strangles, so it's primarily those triangle patterns that we talked about. But sometimes we get stocks that are just really expensive, and we try to keep our risk at $500 or less per alert that goes out. Now, each individual trade can have a few different alerts, but each alert at $500, and sometimes you just can't do that and create a reasonable trade. So we created the high value, and that was at the suggestion of our subscribers. Some of them say, well, we have a little bit bigger accounts. We're willing to take a little bit more risk. And so we would like to be able to trade those. And so that's where the high value came from. So you can see the entry here was $7.39. That's clearly above $5. So that's why it was in the high value portfolio. So here is the entry, and you can see it shows you exactly what the trade is, the months, expiration, etc. And you get a chart with each one. And you can see we had this huge descending triangle, and it had broken down, but it was coming back to test the breakout. So it was giving us a chance to get in after I missed the original entry, but it gave us a little bit of a bounce back to catch it. And in this case, as you'll be able to see, so the entry alert was sent out on July 9th. The exit alert was sent out on the 26th, so 16 total days in the trade. And you can see after testing that, it came back and moved down towards potential support. And just, us getting caught up in all that stuff going on with the Chinese government, where they're just hammering any of their companies. First it was the expensive education, then they said it's the tech stocks. They're just going after any company that is making money in China is basically what they're doing. If they feel like they're making too much money, they're putting all these restrictions on them. And so they're getting caught up in that as well. But nice downside breakout. We had the vertical moves lower, gave us an opportunity to go ahead and take that position off. So right at an 80% gain in 16 days, pretty nice profit on that individual alert. Here is our mark-to-market graphs that show where every position is every single day. So we're as transparent as you can possibly be. This is what most strangles look like. Their initial part, you can see it was below it, so it was losing position from day one. That's how it works, because you're buying a call and buying a put. So time decay becomes an issue the very first day, and it will likely trade at a loss until the breakout occurs. So this is a very common look for the risk graphs of strangles. You have to expect that. It becomes a little concerning, I guess, if you become a new subscriber and you join the volatility strategy and you put on 5 new strangles and every one of them is in a losing position, and you can look at it and say, what have I done? Well, that's to be expected. They're going to show a loss until they break out. Unless they break out the very next day, time decay is going to reflect a loss. So you understand that the strangle has a triangle pattern. The triangle going to break out at some point in time. And if it takes a little while to move, then the position is going to reflect a loss until the breakout occurs. But then once the breakout occurs, you can see what happens profit-wise. boom, it shoots up. So it's a very common look of what the mark-to-market graphs look like on strangles. Now, PDD, because I'm certainly wanted to pat myself on the back when we nail the exits, and we do that a lot. But it was down again today. So had you stayed in a little bit longer, it could have made even more. But at that point, it was oversold, and we'd hit a really nice gain. Our returns are right around 30 to 70% in the strangle. So that's the range. So you can see this was at the high end. Usually it takes close to 30 days on average. And this was less than that. So it was about half the time frame and outside the upper end of the range. So at some point in time, you just have to take that. And when you go back and look and see that here we were getting awfully vertical on the downward move. You know, I don't like vertical moves because what goes vertically up or down quite often goes vertically right back the other way. So certainly don't want to leave that kind of profit on the table. Nobody gets in and out at the exact tops every time. Very nice trade. Can't really complain about it. So I wanted to show you that one because it was in one of the different portfolios. So let's go back and take a look at our, so that's the alert service, by the way, which is subscription based. And we send you out alerts for entries and exits, as you saw, any adjustments along the way. We're going to go through and look at some of our case study considerations here that we do in TradeFinder, where we just give you an idea and then you take it from there on what you want to do with it. And then you're kind of left to make your own decision on the closing price. But we guide you on that with the alert service. That's what it's for. So let's go back and look at POLY, which was PLT at one time. Plantronics changed their symbol to poly for whatever reason. You can see clearly the triangle pattern that we had here. We made an adjustment in our portfolio to this. You can see where we are now. The stock broke down and it just wasn't really profitable. That move there, and you're like, well, why not? That was a big move. Well, there was a ton of volatility that was priced into this because the stock can move. And so it moved back to the upside. And this was the expected target here. So we're looking to, at this point, take the call off, expecting it to go back down and let the put ride to the downside. Well, then it broke even higher. And so at that point in time, it's like, okay, it moved higher than originally thought. Maybe this one's going to turn and run to the upside. So instead of taking the call off and just letting the put run, what we did was we added 2 more puts. So that was the adjustment. So now we have 2 calls and 4 puts on this. So it's still, I used to call these ratio strangles, where you don't have the same number of calls as you do puts. So it's a little bit of a guide to the downside, but if it were to reverse and go back up, we still have the calls there that we can take advantage of and give ourselves an opportunity to make some other adjustment if we needed to. So we wouldn't be sitting there with no calls at all. So that, I thought that one was interesting. That's interesting adjustment. So after we've doubled up on the puts, obviously today was a nice move to the downside. We'll see if that continues lower, but that one's looking pretty good. Then we go back to ASAI, which was on the 1st of June. And we take a look at, that was a wave 3 from our momentum search, which is looking for lower dollar stocks that have good solid technicals behind them, not just heavy short interest. And we've gone sideways. Now we did this on one before where I mentioned when you see this kind of a move, what makes sense is to adjust this into a triangle because it's gone and consolidated right into a nice triangle. So where it might have been long before with calls or whatever, a consideration here would be to move that into a strangle. And so I'm going to make a note there on this date that we're adjusting this to a strangle. And now we don't care which way it goes anymore. We're not directional anymore. Now, if it breaks to the upside or the downside, that's fine. Then we look at Marsh and McClellan. That was back on the 15th. And you can see it closed at 140 and pretty nice move to the upside within the wave 5. So back here, you're within the wave 5 target. That's $7 to the upside. So it should have been a pretty nice gain. you can hang in there a little bit longer, but you're probably being greedy. If you look at the DMI, you're like, well, the DMI is just setting up. So that's a fair point. You could stay and trade this longer if you wanted to see if that positive directional indicator turns back to the upside, if this was just something that occurred today. But you can see the doji there. And if you didn't take it off yesterday, again, I think maybe that's a touch of greed, but you have a fair point by looking at the DMI and say, but I want to give that a chance to see if we're just getting started. Maybe this runs even further. But at this point in time, we're going to cross that one off and say that one was profitable. And you know, you're on your own to see if you want to let that one go a little bit further. It'll be interesting to see what happens. Autodesk was one that we had sent out to our subscribers as well. Another strangle, which we sent out the closing alert. You'll see what happened out of Autodesk. Boom. And we timed that one pretty well on the upward move. So it hasn't gone anywhere. So we close it out here on the 23rd. And so talked about how, well, PDD went down another day. Well, we nailed the exit on this one. It was exactly right. So that was nicely profitable. We've closed it out for our alert subscribers. They got the closing alert. So we're going to close that one off as well. And so you can see that we're going through some of these here. DCI, now we're at July 13th. So moving up here, and this one's kind of just gone sideways. Consideration here might be a strangle as well. Looking at that, so take a look at the DMI. That's an awfully high ADX. Got the negative directional indicator moving up. So at this point in time, you know, putting it into a strangle, I think makes sense. So we'll write that down as well, especially when you're looking at the weekly chart of the market, which I was talking about with that divergence between the ADX and the market itself. Then last week, we looked at Quest Diagnostics. So you can see here, trading at 136.27 and nice move to the upside since then. Trading up at 140 now. Last couple of days, trading up there. So it's been moving nicely. Look at the DMI, and you don't want to see that positive directional indicator break below the ADX. Would have preferred, especially on an up day like we had today, to see that positive directional indicator create more separation from the ADX, not less, where it breaks below it. So kind of want to watch this one tomorrow. You might want to just take a quick small gain on that and move on. But let's see what happens in tomorrow's trade. It does make sense that we're sitting here against resistance there at 140. That's a big deal. And if it can break above that, you might want to give it an opportunity, because you could really take off and run. So if it breaks above it tomorrow and the positive directional indicator moves back up, well, then you want to give that one a chance to really take off and go. So I could see where you might want to do either one, to say, okay, well, I'll just take a little gain and go, or no, I want to give it a chance, see if it can break that 140, because if it does, it could be a rocket ship higher. Now, we made a note on this one last week, CPRT, and the note was to take a look and see, because the spreads were wide. And I looked at it, and the spreads tightened up during the day, which is what we talk about happens a lot. That's why when we look at things after hours, sometimes we can get misleading looking quotes when the bid-ask spread widens too much. And then during the trading day, the spreads come in, and they widen the spreads, as we've talked about numerous times, because there's been so much volatility, especially in the overnight futures, where the majority of the market moves has been in the futures overnight. Not nearly as much happens in the trading day as it used to. It used to be the exact opposite of that. The futures would move, but the big part of the trading was during the actual normal trading hours, and it's the exact opposite of that now. So quite often, if you have a stock that moves or has some volatility in it, the market makers will widen the spreads and close. and it looks like, oh, you know, the spreads are too wide, it's too much slippage, and you let it go. So we said, let's take a look at that one, and the spreads are nice and tight during the trading day, so that works out fine. So if we go back to where we were on the 20th, so it was that trading day there, and we've moved higher. So the close was 139. We closed up at 146 a couple days ago, closed at 146 today as well. Really nice move. You look, that's a much better looking DMI, except the positive directional indicator is moving down here, and the ADX is broken 40. So I think you want to go ahead and take that gain too. Now I know these are small gains and not what we're used to, but this is part of the process of when storm clouds are building, and yeah, the market's going up, but every time it goes up, it's weaker and weaker and weaker. That's when you take smaller gains and move on. You're happy to take an upward gain when the market's doing that. Take your profits and move on. So we'll go ahead and close that one off. That one was a watch list, so I don't know if anybody followed that one or not, but I did, because it made a note of it that we wanted to take a look and see what the spreads look like during the trading day, and they were fine. So that's it. So that's again, we don't have too many open ones for a while there. We had several, but they've all moved. And we've generated a lot of nice gains. We did close our second loss. So hopefully you've been watching those. Time decay took effect on some of them, but the moves were there throughout the course of the last couple of months. So again, not much left. So with that, let's go ahead and take a look and see if we can find a case study for tonight. And then we'll open it up to some questions. We might actually get done right on time tonight, since we don't have as many of our case studies to look at, or case considerations. Looking at the momentum scan, zero, nothing. So that's pretty interesting, isn't it? Because it's set up to capture lower dollar stocks, as I said, that have good technicals behind them. And sometimes you can get those big explosive moves that make all the headlines, etc. So we want to try to do something that was a little more prudent, but there's nothing there. So from there, the next thing we go is to look at the bullish impulse. And by the way, if you're wondering about the software is called Profit Source. A lot of people make comments about it because the charts are really clean, easy to see, it's easy to work with. The Elliott wave patterns are great. To me, it's the best Elliott wave software out there. It's programmed exactly from the Elliott wave mathematical algorithm. In other words, there's no personal adaptations that are included into the programming. It's just purely right from the actual algorithm itself that Elliott wrote. And a lot of our subscribers use it, I think maybe because I do, and so they follow along with it. And so the folks that created this, by the way, you can find out more about it at profitsource.com. These Elliott wave options things here are for those that are alert subscribers with Elliott wave options and have Profit Source. Then they enjoy all these extra ones. So all the people that have Profit Source that aren't Elliott wave option subscribers don't enjoy these extra tabs. So they did that for us, which was nice. And these ones that say EWO are actually mine. Those are my search parameters that are create confirming indicators, a set of confirming indicators that utilize to complement Elliott wave. So we look at those first and then apply Elliott wave. That's basically the system. So taking a look, pardon me, at the bullish impulsors too. Johnson & Johnson, wonder why that one's there. It's actually been there for a couple days. So let's take a look and see what it's looking like now. So you can see here's all the confirming indicators. So we can take all that stuff off and then apply the Elliott wave. And so it's not in a 5-wave pattern. So we look for that, and oh man, there's all kind of stuff going on in this pattern. So let's look at this zigzag here. Right to 100%. Look at that. Dead on 100%. Comes back to the 38.2% level, and then turns and heads back up. So we're testing that again. So that to me looks like it's a complex A wave and a larger zigzag. So then we can go here and come down to this level, which gives us a target up here you like it when these targets converge. In other words, the 161.8% extension level of the first zigzag and the 100% extension level in the larger one are almost at the exact same spot. So you're looking at approximately 180 as far as a potential price target. Now we do have to mind the fact that we are right at those recent highs. So does that act as some resistance? Look, there's another one too. There's another one right here. So we have a, look at that. So 100% there at 174, 161.8%, 180. How about that? There's three different zigzags giving you roughly 180. Two of them are extended. One of them is just the normal 100%. So I think there's a great chance it may have a little pause here around 175, but if it breaks that high, I don't think it's going to pause there long. So it looks like a 180 target there. Boy, that's hard to ignore. Let's look at the DMI again. You can see that one had a little tick up in the positive directional indicator, even on a down day in the market. So that's what you want to see. So Doji yesterday moved to the upside today, new closing high. So the high was 172, but the close was 170, and the close today 172. So a new closing high. So technically it's moved above that. So here comes that confirmation day again, right? We want to see another higher close tomorrow. That's the key. Yeah, the CCI has room. Good volume, solid volume today, not ridiculous volume to where it would be running out of gas, just good average volume. That's what you want to see. Now, ideally, you would see another update tomorrow on above average volume. That would be an awesome follow-through day or confirmation day, but that's going to be hard to beat right there, even as I just showed you the storm clouds on the horizon. But you all know why Johnson & Johnson is doing well right now with everything that's going on. So we'll probably be using that one, but let's take a look at another one. So ADP, and that's a pretty good looking chart too. Look, these are both looking pretty good. We're at 111% extension. So remember when I was talking about the XJO, the Aussie market, when I was saying that you wanted the wave 5 extension to get above 100%. So when the correction comes, it's not as severe. That's what I'm talking about. See, the wave 5 is extended 111%. So when this one does correct, you're going to look for a correction at 61.8% of this wave 5. So you simply use the fib retracement tool. And if it were to start today, so if the correction were to start today, your target price would be 178, not all the way down to the previous 4. So the further it goes up, you just redraw the lines, you redraw the fib retracement levels, and that's where you come up with your potential targets. But looking at that DMI here, this one goes on the watch list. So the wave 5 looks really good, but that ADX, and I set my search up like this on purpose, and you may wonder, well, why would you have a result that wasn't ready yet? I look at the ADX breaking up above 20. If you read about the DMI on the internet or some other resource, you'll look for, you'll see or you'll read where they say when the ADX breaks above 25, between the two directional indicators, good separation, all the rules that go along with it, that's when you have verification that you're in a strong trend and you can put on a position. It's been my experience over the years that it's very rare that the ADX comes from underneath 20, breaks above 20, but doesn't then go and break 25. So you're giving up the movement of the stock in the trend as the ADX moves from 20 to 25. And the ADX is not super responsive day to day. The two directional indicators are, the CCI is, but the ADX can be a little lagging. And so why give that up if there's very few times when the ADX will set up and it looks perfect, the rest of the DMI, the directional indicators, everything looks great, and the ADX breaks above 20, it doesn't make it 25. If that happens so rarely, let's be a bit more aggressive on that. And remember, we have a lot of other confirming indicators. We're not just relying solely on the DMI, so other ones are backing it up. And then we have that chance to go ahead and put a position on and maybe catch a bigger part of the trending move. So the way I set the search up is before the ADX breaks above 20, so that I can put some on a watch list and keep an eye on them and catch it right when it breaks above 20. Because if you just put on there that it's broken above 20, then you can get some at 25, 28, 30, etc. And you may have missed some. So what we're going to do is we're going to go ahead and, so for today, we're going to make J&J with an upward target of 180 as our case study consideration for today. And then we're going to do a watch list on ADP, and let's just see what happens. And that DMI is setting up really well. And you can look at that and say, look at that. It's going to break above 20 in a couple days, maybe, but they don't always do that. So 20 is an important key, where I said it's rare that it breaks above 20 and doesn't break above 25. Well, there are plenty of times when you have a DMI that looks like this, but the ADX doesn't make it to 20. So the difference between those two scenarios. So in this case, you can't look at it and say it's going to break above 20. Maybe it does. Hopefully it does. But you don't enter a trade until it does. It has to actually break that 20 level. So as long as we keep this great separation here and we get the ADX to break above 20, that could be a good entry. So that goes on a watch list, and maybe it does it before we get together again next week, or maybe not. But it's pretty interesting. So with that, I'll go ahead and take some questions, and we will finish on time. Our target is to finish within an hour on these, and we've had some extra case study considerations waiting on the market to move, but now they've moved and generated their expected moves, so we don't have as many to go through, so we can get done in a more timely manner here. We do respect and appreciate everybody's time, and the time that you spend with us, we appreciate as well. Can we go through and talk about trades that lost money? And some nice comments first, and talked about it. Yeah, I mean, we actually, which one did we close out? We closed out one of our trades here that was a loser. We haven't had many losers within TradeFinder, but I can make a note of that, and the feature trade next week can be a losing trade. I don't have any problem with that, because nobody's right every single time. So we'll put down for next week, highlight a losing trade. And we like to actually make adjustments when a trade doesn't go the right way, but we can do that. And we haven't had many of those to look at throughout TradeFinder. So James asked, with the Google alert today, and I sent out an alert on Google with the earnings report, which that's something that you certainly want to be careful of doing, putting a trade on a day of earnings. And so we used a spread. So the question is, why did we use a vertical debit spread instead of doing another butterfly? Couple of reasons. Good question. Couple of reasons. One, remember that the butterfly doesn't work so well when you have high volatility and then the volatility tanks. You can do with stable or low volatility with the butterfly, but you don't necessarily want to put it on when the volatility is high. That's why we haven't been doing as many out of the money butterflies, because the VIX has been elevated for so much. It's one of our favorite strategies, but you have to take that volatility into account, or the trade doesn't work very well. So that was one of the reasons. And then the other reason being on an earnings report. Now, the way we do out of the money butterflies, which usually generates a lot of buzz when we talk about them, because we're taking a strategy that's normally designed to be a sideways, non-directional strategy, staying a trading range and making it directional. So by placing it out of the money, you still make money by being right on direction. However, the position is time decay neutral in the beginning and moves towards time decay friendly as you move towards the expiration date. So you don't have to put it as far out. Well, knowing that it was Google going into earnings and earnings being, or a movement being priced into it with the extra implied volatility, if it gets a big move, and it may, and if it holds through, it should be a big pop on the open. Well, that's not the ideal scenario for making money in an out of the money butterfly. It will be profitable. The out of the money butterfly would be profitable, but by the nature of it, you get a big explosive move. That's not the ideal scenario. The out of the money butterfly works great when you have just something like this, just a nice churn to the upside. I mean, that's a golden strategy. So if you come here and you see it right around in here, and you've got a target up here, so you put the butterfly up here at the target price, out of the money from where it's trading, and you get a nice trending move, there's nothing better. It's the greatest thing ever. But it isn't the best position when you get a big move, and that was the possibility on earnings, and then the fact the volatility was too high. Now with the debit spread, buying and selling one contract of each, it tends to neutralize that a bit, especially being as far out of the money as it is. So it's a better strategy when you have the higher volatility like that. So I can understand where the question comes from, but hopefully that helps to explain it. Joseph's Tesla seems to be making a 3-month or so descending triangle. Yeah, we actually have talked about that, and we have a triangle on that for our subscribers, and could see that it had pretty good earnings report and then broke to the downside. Couldn't really figure out what it wanted to do. It opened higher and then traded lower. But we were looking at this triangle right here. And I assume by talking about the descending triangle, you're talking about this bigger move here, like that. And it has, I mean, it's got the set of lower highs. It's a little bit of a bounce up here, so you could kind of draw this support line up here, which I think makes a bit more sense, and that takes into account those tests there around 600, right at the 600 level. I mean, they made a lot of money, and everybody's been waiting on Tesla to make money. Now they make money, and the stock doesn't trade as volatilely. Is that a word? It's not as volatile as it was when they were making no money. So, you know, it's like, what do people really want? It's hard to know, but that's when a strangle makes a lot of sense. So yeah, I'm with you there. I was looking a little bit more shorter term than you are. You're looking at the longer term descending triangle. We were kind of looking at that shorter term symmetrical triangle. But look what happened today. So you got like a double whammy here. It opened outside of the upper end of the triangle, traded to the lower end, and closed right smack back into the point of the triangle. Look at that. Look at the close is dead in the middle of that symmetrical triangle. So it gave us no indication of which way it's going to go. So we'll see how it trades out over the next couple of trading days. I think what happens in the market from a risk appetite could be really interesting. Someone is asking about the Qs. An expanding triangle on the Qs. I can see what you're looking at there, and looking at that as the point, and then here it's not as well formed as some, but I can see what you're looking at, and it makes sense. You've got the little bars, and you probably could bring it down a little farther to these little bars. In fact, let me redraw that after taking a closer look at the chart there, and what you're looking at. These small bars there would be the point, and this is a bit of an aberration and tried to break out, but no confirmation. So back in. So yeah, I see what you're looking at. It's and an expanding triangle is that megaphone looking thing. If you're not really familiar with expanding triangles, I've been talking about this over the last several months. Expanding triangles, yeah, they showed up, but they weren't all that prevalent in past years. Over this past, we're going on 2 years now, I've seen more of the expanding triangles than in the rest of my other I've been trading options for 25 years, and the other 23 years combined, I think there's been more of them. It's amazing how many expanding triangles there have been recently. So Mark says the USD gives a good indicator for future moves. Can you review it? So in what way, just out of curiosity, Mark, what way do you think, because there's a lot of talk about the dollar and what it means. So some people like a weaker dollar because it helps international profits with exchange rates, etc. Other people like the strong dollar because it shows that companies are in really good shape and the US economy is in really good shape, but it's more expensive for international companies because they lose on the exchange rate. So over the last 10 plus years, or maybe somewhere around the last 5 to 10 years, let's go, there's been a race to devalue your currency. Every country wants to devalue their currency because trade has become so international, and it favors companies that trade that have international trade from the exchange rate. And so it's like, when the dollar goes down too much, then it becomes a sign of economic weakness, right? So we talked about that when we moved down, and so I didn't want to see the dollar go any lower than that, because to me, whether or not you go with the argument of you like a weaker currency because of exchange rate profits for international companies, et cetera, at some point it starts to show economic weakness, and that's never a good thing. And I don't want the dollar, in my personal opinion, is I don't want the dollar to go too far down. I like having a bit of a stronger dollar because you want the dollar, especially when we have a Federal Reserve that's just printing money like crazy. And I used to say that, and there would be always somebody in the audience when I was doing live seminars talking about the Federal Reserve printing money. There'd be always somebody that would say, no, the Treasury prints money. Okay, let's be politically correct. The Federal Reserve authorizes the Treasury to print the money. The Treasury actually prints it, but they print it at the direction of the Federal Reserve that's doing all this quantitative easing and just throwing money willy-nilly out it, and we're just creating money out of thin air. And it's going to get dangerous one day if we ever get to the point where the dollar doesn't seem to be that last bastion of safety, the currency of last resort, if you will, when there's global economic weakness. If we ever get to the point where the dollar starts to lose that status, we're in a mess of trouble with the amount of debt that we have. We need the dollar to stay strong so that when there's global economic weakness, money comes in and supports the dollar rather than the dollar tanking. And people say, well, if the dollar's that weak, let's buy a different currency, or let's create a different one, or some countries get together and create a basket. That stuff scares me for the future. So I like having a bit of a stronger dollar, but my point is that there's arguments on both sides. There's arguments for a weaker dollar. There's arguments for a stronger dollar. Which one do you fall in line? And probably the best scenario as far as the markets is to have just, a stable dollar. So it doesn't get really weak, doesn't get really strong, just good stability. So companies can figure out their budgets. They don't get surprises on the exchange rate, et cetera. And I think that's what makes the most sense from a profitability standpoint and an economic standpoint. So I'm pretty good with where the dollar is right now. I like having it up here. And we don't want to see it take off too much and become an inflationary thing, whatever, because of inflation and stuff. So right where it is now is good by me. If it just wants to go in a trading range here, but it broke down a little bit today, but it's had a pretty nice run. It's not in a wave 5 pattern. So we had this triangle down here, which was really spooky to me, because if that broke to the downside, I don't think that would have been very good news at all. It didn't. It broke to the upside. So there was an upside break with the dollar, which that was good. So I'm pretty good with where the dollar is right now. Angel on Hill asking about the XLF. And let's look at interest rates. Now, interest rates start ticking back up, then it's a different world. And you see the financials, they have no idea what to do here. because the interest rates were going down, and that's impossible scenario for financials to make money in, because the spread tightens. Remember, financial companies, they borrow on the short end, lend on the long end. And so if that's, they need that spread to make money. And if the spread is so narrow that they're borrowing and lending at roughly the same rate, they don't make any money. So they need interest rates to go up. So the rates continuing to come down, I don't think is a positive for the financials. There's, you know, arguments over what it means. Some talking about recession, etc. But I just, as far as the XLF, looking maybe at a strangle or something along those lines, might make more sense. If interest rates do move up, then you could see a big break, because that's a long consolidation, right? It's been consolidating through the entire month of June and July. So had a pretty good run into the beginning of June, and we've gone into a nice consolidation. Yeah, I was going to say probably following a wave 5, which is exactly what it was. So really nice symmetrical triangle. That's classic Elliott wave stuff. You have a wave 5 that completes, and then you go into a corrective triangle, and it could break either direction from here. I think that makes a lot of sense in the XLF. I would be nervous to go just long unless interest rates turn around. If they do, then it's a whole different ballgame. But with rates that low, it's a lot of pressure on the financials. Now, some of them do have good trading desks, and they can make some money from a trading standpoint. But as far as general financial and banking type business, it's brutal for them right now. But I think a strangle makes really good sense right now. Look at NVIDIA. Some of y'all asked the same questions. That's interesting. I bet that's expensive, but you're right. I mean, that looks good. Let's see. I'm afraid that the ADX might be a little too high. Yeah, see that we really like it when the ADX breaks below 15, 13 is ideal for me. And you look at that and you say, well, why? It's clearly a good triangle pattern, and it is. And I want to be very clear that stocks in a nice triangle do not have to have an ADX below 15 down around 13 to break out. This has a doji today that could break tomorrow. It could break up or down either way tomorrow. The reason that we like the low ADX is the ADX diving down represents consolidation. And what can happen is you have what looks like a really good triangle here, and then it kind of churns for a while, maybe false breakout to the upside, false breakout to the downside, which our subscribers know that doesn't happen. That means you're building a larger triangle. And so time decay is wasting away, which can happen anyway. But when you have the ADX higher, it's not reflecting as much consolidation. So prefer to wait for a bit of a lower ADX. Now it's diving down and it's trying to get down there. And that doji today is certainly quite interesting. And this could be one that I miss just because waiting on that ADX to get lower. So there are times when there's nice triangle patterns and they break out and the ADX isn't below 15. But with time decay being an enemy on a strangle, that's the challenge. But I could certainly see why you'd want to put one on right now, because that's a great looking triangle. And it's also my favorite setup, which is following a big run up in price. And it's kind of almost vertical like that. When you have a big run up in price and then you go into a symmetrical triangle, man, I love that pattern. That pattern breaks out and you have no idea which way. I used to show in the live seminars that I would do the exact same pattern. I mean, if I covered up the stock, you'd think it was the same stock, and one broke big to the upside and the other one broke big to the downside. Exact same pattern. And so that big run up, yeah, I really do like that setup. Maybe I'm being a little too picky, wishing the ADX was just a little bit lower, but that's the way I view things. But yeah, that's a wonderful setup. ADP, well, we were waiting on that, right? When we're waiting on ADP. So it would be an upside trade, but it's not ready yet. We got to wait for that ADX to move up. So don't jump the gun on that. Remember, that has to happen before you get in. So taking a look at Boeing, and don't get confused between the TradeFinder or case study considerations that we identify every Tuesday night. It's not the same thing as the alerts that we send out in our alert service. Okay, that's a difference. So we have Boeing to the upside in the alert service, but we never identified Boeing in TradeFinder. We never talked about it. So they're two different things. So don't get the two confused. Remember, the alert service, we send the entry and the adjustments and exits. All those things are sent with actual alerts through text message and or email. Both of you prefer. So that's why we didn't look at Boeing, because that's Thursday night. We'll look at that Thursday night. Made a nice move in its consolidated sense. So we'll see if it can move higher from here, which would be really nice. Yes, all the alerts will be discussed on Thursday night. Rob, you talked about making debit spreads in the money to avoid the market makers, and they are exactly the same as out of the money credit spreads. They also limit profit like credit spreads, correct? They do. Yep. They do have limited profits, limited risk, limited profit in the spreads. In the money debit spreads and out of the money credit spreads are the exact same thing, and vice versa. And they both have limited gains. So that's why I kind of like to make the spreads a little bit wider. So the one on Google that came out, was 200 points wide. So you try to make them as wide as you can because of that. Sure. Baidu, Pankaj. This is tough one because they're both Alibaba and Baidu are getting oversold, and you got profitable puts, and at some point in time you're probably going to want to take that gain. Maybe there's a little bit more. This doesn't quite look quite as oversold as Alibaba does. So the line anywhere from 140 to 150 would be support. Stronger support at 140, but it could come in depending on how oversold. I mean, if it tanks again tomorrow and hits 150, then you're pretty oversold there. But 140 is the line in the sand. And then if it can't hold that, then 120 is rock solid support. If it breaks that, who knows where it can go. So it's coming down to some pretty good areas of support. Right now it's hanging in the middle of nowhere. So it really doesn't have any kind of support. I mean, what was that low? Was 153. So yeah, they kind of stepped in a little bit as it got down there, and it opened down there, didn't it? Right. It opened at 155. So they stepped in a little bit. So there's a little bit support at 150, but 140 is it. And then if it can break that, so just keep a close eye on it. See if it tries to bounce off 140. I mean, if it bounces up, it might give another entry. I mean, it'd be great if these would go back up and test these levels. Because if who knows what the Chinese government's going to do, if they're going to back off, or just, it seems like they don't want to. Seems like they want to revert back 50 years in China, back to the old days. Seems to be their rhetoric. So anyway, that's anyway, the arrow is not, I'm not saying it's going to bounce tomorrow. What I'm saying is that if we got a test of 180, it'd be another good short entry. That's what I was trying to say. So yeah, you're in your areas there. TWLO and silver, and then we'll wrap things up. Twilio. So it's been churning since this wave 5 ended. Looks like it made its 61.8% retracement. See, there you go. Boom, hit it there, bounced up, came down, tested it again, bounced up back there. So there's that 61.8% correction after a wave 5 completes. That's over 100% extension that I was talking about. So we've just been going sideways since then in a big trading range. Now you do have, but it looks like it may be complete already. Zigzag here. Yeah, see, it's already at 161.8% extension. Now, it did come down and test the previous level, which clears the way to go up to 261.8. It's really kind of hard to imagine it doing that and not going up and hitting that level and testing that wave 5. But remember, not that many stocks. The percentage that extend to 161.8% is high. The percentage that extends to 261.8 is much lower. So it can happen, and it looks like this could be one that it might want to, but you had a negative cross there with the directional indicators, and the ADX gave it no kind of love at all on that move there. Didn't seem to think there was any strength to that. It just went straight down. So the potential is there, but the key level to watch is right here, right through there. So call it 360. It could come down to 360 and maybe hold there, test it again and go back up. But that's the DMI is not really giving us much, and neither is the CCI. So I don't know. It's hard when it's already hit 161.8% extension. It seems like you need to just wait for the next big move to show itself. Silver. These might move tomorrow, right, with the Fed. And it's back down at support here, right at 23, which is pretty interesting going into a Fed announcement day tomorrow. So sitting right there on top of that support level with the Fed coming out, and it's not in a wave 5 pattern. So consolidated 24 for a long time, then gave it up. And then now we're down at the next level of 23, traded below it, but came back up to it. If it breaks that, there's some support at 22. And then, I mean, so it's like dollar steps here on silver. The next support at 22, then 21. But I think I would watch how they trade tomorrow based on what the Federal Reserve says. See, it's not really oversold. The high of the day was still near the 10-day moving average. But they tried to push it below 23 and it held. See how that holds tomorrow. Now, the problem is if you wanted to go long silver, if it bounces, now it's going to bump its head on 24 because it went so long building that support that now it's going to run into a ceiling there. So it just seems like silver is kind of trading range bound. And again, I'm not a fan of doing the at the money butterflies, but that's one that you could probably look at there somewhere to 24, 26 butterfly. Makes a lot of sense right there because you got a lot of resistance at 26. You got good support at 22, and you got this midpoint, which should develop some support resistance there at 24. That could make an awful lot of sense. And again, if you know or have heard me, I don't talk about at the money butterflies very often. I just don't like sideways stuff. I find it too difficult to predict when a stock's going to go sideways. But that one looks like that one could work longer term. So again, thanks everybody for your attention. If it was your first one, hope to see you again next week. Hope to see everybody again next week. Thanks again for spending an hour with us, and I'm glad we got it back on schedule timing wise. So we'll see what the Federal Reserve says tomorrow, and we'll have a recap of that in the next market update here in the next day or two. So take care, everybody. Look forward to talking.